Good morning, everybody. This is Pope Binary here, and today I want to give you a special video. This is actually a video of bad reversal strategies, right? It's kind of weird that I'm making a video to help y'all, to teach y'all how to do the wrong things, right, I guess, but these are strategies that over time, as I've been watching the charts, especially because I trade the 5-minute charts, these strategies do not work on the 5-minute charts. And let me just give you some examples here. So the first bad strategy that we have here is called, I don't really know what to call it, but I just call it the pulling the trigger too quick strategy. Okay, so let's take this hypothetical situation here, and let's imagine that we've got a support level here, and then we have a bearish signal signifying that the market is switching directions. Okay. Following this large bearish move, there'll be three, generally it's 2 to 3, really small bearish candles that have really large wicks. Okay, see what I'm talking about here? These three candles with large wicks, and then out of nowhere, right? Out of nowhere, you'll see a bullish engulfing candle. Now, why? Yesterday I released a video about a reversal strategy that I like. Why is this a bad reversal sign compared to the video I put yesterday? I'll put the video link in description. Feel free to check it out. But why is this different than what I showed you yesterday? For one, see how there's a big big bearish candle. This signifies that the move has just begun, right? And then all of a sudden we hit immediate resistance right here. We hit immediate resistance, and then it's almost like it's too early for this bullish confirmation candle to arrive. It's too early and it's too large. And then another thing is the top of the candle. It'll see on this bearish candle right here. If this bullish candle does not break the open of that bearish candle, which is what this black line signifies, if it does not break it, and you can indicate because there'll be a small wick on top of this bullish candle, if it does not break that line, then that's a dead indication that the market is not ready to switch directions yet. It's too soon, and the candle is too big. And generally, I found, honestly, I had trouble when I was first beginning trading identifying that this was not a reversal set pattern. And so I actually, whenever I see this, I bet on this candle. Actually, I bet that it's actually going to go down, and you can make lots of money doing this. So I guess I'm teaching you what is a bad reversal sign, but also teaching you how to capitalize off that bad sign and make money. And I've got an example here on the Japan chart. This is something I noticed earlier, and I saw this arise, and I did not take the trade. And I feel like a good 90% of people would have taken this trade. So do we see right here, how there's a bearish surge? There's a bearish surge, and see how there's a huge candle right here, which is the meat of the move. And then we get three small bearish candles, all with really large wicks. And what the large wicks tells you, why this is a bad reversal sign, is that the bulls on 3 separate occasions, they tried to push the market up, but they failed. They failed, and so these 3 candles, they signify that the bears are still in control of the market. And so when I saw this candle, first, it was not an extensive bearish move, right? It did not go down a whole lot of pips. And the fact that it approached this value, that this large bearish candle, it approached the opening value, but it did not break it, right? It did not break it. And so I did not take part in this trade because these are risky trades. If you want to try trading this on a demo account, you're welcome to. But I mentally said I think it's going to go down because it's too soon, too quick. There's not enough of a bearish move to validate this sudden reversal. So that's a strong pattern that I find is a very, very, very bad pattern to bet on. So the other strategy is, I've got 4 for you guys today. Another really bad reversal sign is, let's take this hypothetical. Let's say the market is moving upwards, right? The market moves upwards, and then we approach a support level. Now, this last green candle, this is what I base my support on. Okay, and if I see if I see following this support, these support candle or the resistance candles, meaning the market does not want to move above this value. It does not want to move above this value. If I see a bearish engulfing candle that does not break the open of this bullish candle, right? If this candle right here does not break the open of this bullish candle, I do not take that trade, because a lot of the times I'll be honest with you guys, a good 70% of the time the market will continue downwards, but 30% of the time it'll bounce back up to the support level, which is what these dots indicate. Basically, it means the support will continue indefinitely until a new trend is set. So a lot of the times you'll notice this green candle will form if it does not break the open of this initial bullish candle right here, and so that is a bad reversal sign. This is the reversal sign that I'm talking about. That is a bad sign. And on the flip side over here, we've got the good version of this, where it will actually be an engulfing candle that breaks the open of this bullish candle before it goes into support. And see, a lot of the times, this is what I consider a good reversal signal, and I will enter on these trades 100% of the time because that's my system. And always stick with your system for better or worse, so even if you're wrong, you can amend it and make it better. And so I'm probably going to devote another video to this, but this is basically, if you know about the double bottom or the double top strategy, it basically, I can summarize it really quickly. It looks like this. The double bottom strategy, it's when you approach a value, which would be this value right here, and then the market suddenly switches directions, and then if you see that it goes back down but does not break this value, if it does not want to break that value, and you see right here that the market continues to go upwards, that's a double bottom, okay? And so that means that the market wants to switch directions, right? And so basically, why this over here, this is an example of a bad double bottom strategy. Because I find as traders, a lot of the times you like to make excuses, and you want to see the patterns forming in your head. You're like, if this candle forms this way, then it'll bounce up, so I need to bet up now. And as I was beginning trading, that's where I lost a lot of my money. Listen to what the market is telling you, not what you think the market is going to do. Okay? And so what this indicates is, let's say there's a large move, then the market consolidates upwards, and then you see the market go back down, approach a value, and then go back up. See how this is kind of a double bottom, right? It goes like this, and like at this point when you see this going up, you're like, oh, the market is going to continue this way because it's a double bottom. I never bet on a double bottom that is below this value, because that's saying the bears are still kind of in control. And it's easy to imagine that this is a double bottom, this is a turning point. It's easy to imagine that, but a lot of the times that can be wrong. And so what I bet on is, I would even bet on a double bottom that looks like that, right? Because that signifies that the bulls are finally taking control of the market, right? I'll sometimes, if it's a clear signal, if there's a clear engulfing candle right here, I'll bet upwards, saying I think it's going to be a double bottom. But this just highlights that the double bottom does not necessarily work. If you bet basically just predicting instead of watching, right? Predicting is very risky in the stock market, especially on the 5-minute interval. It's honestly just better to listen to what the market is trying to tell you. And so this right here, this is just the same. There's a thing called a double top, and it's essentially the same premise. And just know that a lot of the times with the double top, there'll actually be a triple top before it goes back down, especially if it's a large move up. That's called a spike and ledge pattern. I'll devote a video to teaching that to y'all. Just know that, be very careful if on a double top you see something like this, right? And you can make excuses saying, oh, that's the double top, because a lot of the time what will happen is it'll go like this, and then it'll shoot up, right? And it's just consolidation. So this is just a bad reversal strain, banking off these double tops and double bottoms. And so actually, I think that's it. Those are the 4 reversal patterns I skipped this side. One last little reversal pattern that I want to tell you is it's a very, very, very bad reversal sign that a lot of traders, I see a lot of people, because I run a little program here at my university where I'm teaching kids to trade binary options, and a lot of kids, they love to jump off of this right here. Okay, so let's say hypothetically there was a large move upwards, there was a support, there's a support right here, and then this candle is a huge engulfing candle. Okay, and then you'll notice there's a cross doji followed by an engulfing, relatively engulfing bullish candle, and I say engulfing in reference, it engulfs this doji candle. This is a very, very, very bad reversal sign. Because what this is saying is this could just be a large consolidation. So let's say on a price action, this would look something like this, right? And then we would see a large move downwards, followed by the doji, which is what I'm drawing right here, followed by a large move upwards before the market continues downwards. Like I said, these reversal strategies, they work. They honestly, if they can work about 70% of the time, but the 30% of the time you're wrong, because these are generally in the money trades because everybody wants the market to switch direction. These are in the money trades. If you lose, you're going to lose a lot of money. So I do not bet on these because this could just be consolidation. And so you just have to watch out for these. I think I had an example earlier of that type pattern. And let me try and find it here for y'all. It's right here. Okay, this is again on the U.S. Japan chart. So we see how there had been a long streak of support, and then out of nowhere, this bearish engulfing candle is followed by a doji, which is followed by a really large engulfing bullish candle. You see this? And then immediately the market keeps going down because the market wants to go down. You see what I'm saying? If you don't know about me, I'll throw it in. I always say this every video, but always look at the overall direction of the market. Always look at the overall direction of the market, and always play with demo money before you try this on your own. And so I saw this bullish candle form, and I was like, I'm not going to place my money on this because for me it's too soon, too quick. And I always wait to pull the trigger. And another lesson that a lot of traders need to learn is generally when you start trading, I probably put in thousands of trades, demo and real money. Not necessarily real money thousands, but demo money, I've put in thousands of trades, and I've started to develop kind of a gut feeling. And that gut feeling, if I just have a feeling, if I'm looking at the charts and looking at the overall direction of the market and whatnot, if I have a feeling that trade is going to be a bad trade, I do not take it. And I strongly recommend you guys take thousands. I do your diligence. Take thousands of practice trades before you put real money on the line. Okay, and just know that if you have a bad feeling about the trade, like if one or two of your indicators are not lining up, and you start finding yourself making excuses to why you want to take the trade, like right here, it'd be easy to say there's an engulfing candle that's forming. The market wants to go up, right? If you find yourself making that excuse, despite the fact that the overall market direction is down, and that's disobeying my number one rule, it would be easy for me to make an excuse and say, okay, I'll just take the trade because I think it's going to go up because it is an engulfing candle, and engulfing candles are strong indicators. It would be easy for me to make that excuse, but I would have lost money. Okay, so just develop a system, guys. Feel free to use these strategies, or rather these lack of strategies, these bad reversal signs. Try and incorporate them in your overall strategy. I'm not selling you anything. This is just a guy trying to teach you what I've picked up along my way. And yes, I blew my first two accounts. I put $200 in, and I blew both of them. Both of them are currently valued at about $17 and $12. Okay, so I've beaten the path, and I've been there, and I've done that. So just try and take this advice and apply it to your own. Subscribe for more videos. I'll be releasing more. And I'd love to teach y'all. Like I said, there's no scammer software here. This is just a guy with passion. And I'll catch y'all next video. Thanks for your time.